Wolters Kluwer (WKL) stands as a paramount example of a resilient global information services and software utility leveraging deep domain knowledge to deliver mission-critical, expert solutions across specialized professional verticals, including healthcare, tax and accounting, financial and corporate compliance, and legal and regulatory fields. The group, which reported 2024 annual revenues of $5.916 billion, serves customers in over 180 countries, solidifying its status as a market leader with highly predictable and defensive revenue streams. The core investment thesis is predicated upon WKL's exceptional margin expansion capabilities, its superior ability to convert adjusted profit into free cash flow, and a disciplined, consistently executed capital allocation strategy highly favorable to shareholders. The company has successfully navigated the complex transition from traditional publishing and information services toward high-growth, cloud-native software and expert solutions, driving persistent operating leverage. This strategic shift, now amplified by the integration of transformative expert AI technologies, justifies WKL's premium valuation and supports its long-term compounding growth trajectory. In 2024, the company maintained strong operational momentum, delivering 6% organic revenue growth, a rate that has been sustained consistently since 2021. This stability, achieved across varying economic cycles, underscores the inelastic nature of demand for WKL's regulatory and workflow tools, which are indispensable to professionals making critical decisions every day. Furthermore, operational performance has been matched by financial discipline, with the adjusted operating profit margin advancing to 27% in 2024. These results translated into robust cash generation, with adjusted free cash flow (FCF) reaching €1,276 million, supporting a diluted adjusted earnings per share of 4.97 for the year. The sustained organic growth rate for 4 consecutive years, 2021 through 2024, indicates a highly recession-resistant business model. This predictability is a key factor supporting the group's enterprise valuation. Simultaneously, the multi-year expansion of the adjusted operating margin, rising from 24.4% in 2020 to 27.1% in 2024, signals powerful structural operating leverage. This consistent margin improvement, even with stable high revenue growth, confirms that the company is successfully executing a favorable product mix shift toward higher margin software and realizing efficiency gains inherent in its cloud transition, thus generating increasingly profitable incremental revenue. Income statement analysis: profitability driven by cloud and AI. The analysis of Wolters Kluwer's income statement reveals a high-quality revenue base and a clear pathway for continued profit expansion, fundamentally underpinned by the successful migration to cloud-native platforms and aggressive investment in artificial intelligence integration. Revenue quality and organic growth drivers. Wolters Kluwer operates with remarkable revenue visibility, primarily due to the mission-critical, subscription-based nature of its offerings. The business model is highly defensible, reporting that 82% of total revenues are recurring. This characteristic provides exceptional stability and forecasting reliability, which is highly valued by investors seeking defensive growth. The primary strategic focus is on expert solutions, which integrate content, software, and services into seamless workflow tools. These solutions constituted 59% of total revenues and achieved 7% organic growth, surpassing the group average and validating the strategy of bundling sophisticated, specialized knowledge with actionable technology. The most significant accelerator for top-line expansion remains cloud software. This segment, representing 19% of total revenues, delivered exceptional organic growth of 16%. This double-digit growth rate confirms the rapid success of the transition toward higher multiple, recurring software-as-a-service (SaaS) models, which carry superior margin profiles compared to traditional print or outsourced service offerings. For the 9 months ending September 30, 2025, recurring cloud software revenues grew 15% organically. Segment performance and strategic transition. Wolters Kluwer's strong group-wide performance is mirrored by robust results across its major operating divisions, many of which are successfully managing the digital transformation while maintaining elevated organic growth rates. The Tax and Accounting division sustained a strong 7% organic growth through the first 9 months of 2025. This performance was driven specifically by strong double-digit organic growth in the cloud-native software suite CCH Access. This accelerated digital growth is crucial because it is successfully offsetting predictable declines in lower-margin legacy businesses such as outsourced professional services and print books. The ability of the division to sustain high single-digit organic growth despite explicit cannibalization of legacy revenue demonstrates the success of the CCH Access platform in capturing market share and maintaining overall divisional momentum. This execution ensures future revenue streams are higher quality and digitally integrated, which should support an increased forward valuation multiple. Similarly, the Health division, particularly its Clinical Solutions unit, delivered 7% organic growth through 9 months of 2025, driven largely by successful renewals for the up-to-date clinical decision support platform. The Corporate Performance and ESG division, targeting the high-growth market for corporate digitalization, maintained strong 8% organic growth, underpinned by 18% organic growth in the cloud software component of the CCH Tagetik CPM platform during the first 9 months of 2025.
The impact of expert AI on margin trajectory. The sustainability of the expanding profit margin is directly linked to the company's commitment to product development and innovation, with guidance indicating that WKL will spend approximately 11% of total revenues annually on this strategic priority. This investment is heavily channeled into embedding proprietary expert AI capabilities into core customer platforms.
The successful early deployments of expert AI features strongly suggest that WKL is effectively leveraging its substantial competitive moat, its proprietary domain-specific data and content, to differentiate its solutions from generic generative AI models. 4. In the Health division, the launch of up-to-date expert AI offers a conversational interface for medical content, attracting over 50 health system customers for enterprise deployments within weeks. In Tax and Accounting, transformative AI features were seamlessly integrated into the CCH Access platform, including CCH Access Intelligence, Workflow, and K1 processing. These AI-driven tools significantly increase customer productivity and workflow stickiness. This supports premium pricing and acts as a structural guardrail against competitive threats, guaranteeing the continuation of the multi-year margin expansion trend. The consistent upward trajectory of the adjusted operating profit margin, rising sequentially from 24.4% in 2020 to 25.3% in 2021, 26.1% in 2022, 26.4% in 2023, and finally 27.1% in 2024, serves as concrete evidence of successful operating leverage and high-margin product mix improvement across the organization. Cash flow statement analysis. Superior cash conversion. An examination of Wolters Kluwer's cash flow statement highlights the inherent structural advantage of its business model, a highly efficient ability to convert reported profits into liquid cash flow, a hallmark of capital-light, subscription-based enterprise software platforms. FCF generation and quality of earnings. The company's ability to generate significant discretionary cash is exceptional. Adjusted free cash flow, FCF, reached $1,276 million in 2024, demonstrating consistent and robust capacity for cash generation. 2. This cash-generating power is further affirmed by WKL's superior cash conversion ratio, which is guided to remain approximately 100% to 105% of adjusted net income. A critical indicator of WKL's high earnings quality is the persistent relationship between FCF and adjusted net profit attributable. In every reported year, adjusted free cash flow has exceeded adjusted net profit. 2. For example, in 2024, FCF of €1,276 million was €91 million higher than the adjusted net profit of €1,185 million. In 2022, this difference was particularly pronounced, with FCF exceeding net profit by €161 million, €1,220 million FCF versus €1,059 million net profit. This consistent positive deviation, where FCF is substantially higher than net income, results from large non-cash charges, primarily depreciation and amortization relating to prior acquisitions and capitalized software development, flowing back into the cash flow statement. Because the company requires minimal cash expenditure for maintenance capital expenditure, this differential effectively adds an extra layer of financial resource. This structural benefit provides an additional layer of capital available for shareholder returns, dividends and buybacks, and strategic mergers and acquisitions, validating the use of the price-to-free cash flow multiple as a more reliable gauge of intrinsic value than the traditional price-to-earnings ratio. Capital expenditure discipline. Wolters Kluwer maintains highly disciplined and structurally low capital expenditure (CapEx) requirements relative to its revenue base. Capital expenditure is expected to remain within the low range of 5.0% to 6.0% of total revenues, aligning with the 5.4% reported in 2022. This low fixed capital requirement is a direct consequence of the enterprise software and data business model, where the primary investment is intellectual capital and product development, guided at 11% of revenues, rather than physical assets.
The combination of superior cash conversion and low operational capex results in a large and growing FCF base. The 2024 FCF of €1,276 million acts as the fundamental engine supporting the company's aggressive capital return strategy. 2. This superior financial capacity insulates the progressive dividend and share buyback programs from potential short-term earnings fluctuations, ensuring that dividend safety is exceptionally high and that buybacks can be funded without significantly increasing net debt. Balance sheet strength and capital efficiency. Wolters Kluwer's balance sheet reflects a highly efficient utilization of capital coupled with prudent leverage, a profile characteristic of premium asset compounders in the software and information services industry. Leverage and financial flexibility. The company adheres to a conservative debt profile appropriate for a business characterized by high recurring revenue and stable cash flows. The reported net debt to EBITDA ratio stood at 1.6 times. This level of moderate leverage provides ample financial flexibility, allowing WKL to pursue strategic, value-enhancing acquisitions without compromising its overall financial health. The financial capacity proved critical in the first 9 months of 2025, where total acquisition spending net of cash acquired amounted to €839 million, primarily related to the acquisitions of Registered Agent Solutions, RASI, and Brightflag. 4. The low starting leverage ensures that WKL can rapidly deleverage following large transactions, utilizing its superior cash flow generation to mitigate the long-term risks associated with debt while integrating high-growth strategic assets. Elite return on capital metrics. WKL's efficiency metrics demonstrate elite performance, confirming its status as a high-quality capital allocator. The return on invested capital, ROIC, improved to 18.1%. This figure is notably strong, significantly outperforming the industry average of 11.39% over the last 3 years, during which WKL maintained an average ROIC of 18.40%. Furthermore, the return on equity, ROE, is exceptionally high at 126.61%, indicating that WKL is amongst the best performers in its industry, outperforming nearly 97% of its peers. 8. This stark divergence between the elite ROIC, 18.1%, and the extremely high ROE, 126.61%, is a direct consequence of WKL's optimized capital structure. The structure utilizes moderate debt leverage and a reduced equity base, the latter resulting from decades of aggressive share buybacks and high dividend payouts. This configuration maximizes the return on shareholder equity, creating a powerful compounding effect, while the conservative debt ratio ensures the leverage remains sustainable. Intangible assets and M&A strategy. The balance sheet necessarily reflects a substantial accumulation of intangible assets, primarily goodwill and other intangibles, stemming from consistent historical and ongoing M&A activity. These intangible assets are subject to rigorous impairment testing, aligning their carrying value with expected future discounted cash flows, a critical accounting process given the nature of the business. The company's M&A strategy, exemplified by recent acquisitions such as Rossi and Brightflag, is strategically focused on expanding exposure to workflow software and next-generation AI solutions, consistent with the group's objective of scaling expert solutions. Management explicitly notes that while selective acquisitions are pursued to enhance long-term value, they may be dilutive to margins, earnings, and ROIC in the near term. This statement highlights a willingness to temporarily accept short-term dilution for strategic enhancement, a pragmatic approach justified by the rapid deleveraging capacity provided by the company's strong cash flow. Dividend safety and robust capital allocation strategy. Wolters Kluwer operates with a capital allocation framework that strongly prioritizes shareholder returns, underpinned by a highly reliable cash flow engine. The commitment to shareholders is formalized through a progressive dividend policy and amplified by opportunistic, substantial share buyback programs. The progressive dividend commitment. The company maintains a deeply entrenched progressive dividend policy established in 2007, under which it aims to increase the dividend per share in euros each year, independent of currency fluctuations. 12. This commitment extends back over 30 years, during which the annual dividend per share has either been increased or maintained. The proposed total dividend for the 2024 financial year is $2.33 per share, representing a substantial 12% increase over the previous year. The proposed increase reflects the company's confidence in its financial performance, future cash flow expectations, and the need for ongoing financial flexibility. The dividend payment is deemed exceptionally safe. The 2024 adjusted FCF of $1,276 million provides substantial coverage not only for the proposed dividend, but also for funding the aggressive share buyback initiatives. Share buybacks as a key capital allocation tool. Beyond the progressive dividend, WKL employs share repurchases as a principal tool for returning capital and enhancing EPS accretion. The company adheres to an anti-dilution policy, utilizing buybacks to offset the dilution caused by annual incentive share issuance. Furthermore, WKL engages in large opportunistic share buyback programs. The full-year 2025 share buyback program of up to €1 billion was completed ahead of schedule in November 2025, demonstrating management's commitment to accelerating capital return. Following this completion, management immediately announced a new mandate, bringing forward part of the intended 2026 buyback, confirming a planned total repurchase of up to $1.1 billion reflected in the 2025 guidance. This aggressive posture on share repurchases suggests that management views the stock as attractively valued relative to its high internal rates of return. Given WKL's elite ROIC, 18.1%, capital is only returned on this scale if management believes that buying back shares generates a return comparable or superior to further investment beyond the already robust organic R&D budget. The accelerated nature of the buybacks serves as an implicit vote of confidence in the underlying intrinsic value of the business. The total capital return, dividends plus buybacks, is deliberately managed within the generated free cash flow envelope, reinforcing WKL's status as a self-funding compounder. Current valuation analysis and price target assessment. The valuation analysis for Wolters Kluwer necessitates reconciling the company's premium financial quality marked by structural stability, superior cash flow, and accelerating digital growth with its current trading multiples. The goal is to determine if the market fully appreciates the strategic shift toward cloud and expert AI platforms. Multiple comparison in context. As a dominant global software and information platform with high recurring revenue, WKL is appropriately valued using enterprise value, EV, multiples. Recent trading metrics indicate a last 12 months LTM EV-EBITDA multiple of 12.1 times, increasing slightly to 13.1 times on a last fiscal year basis. The LTM price-to-earnings ratio, PE ratio, stood at approximately 18.5 times. A focus on cash flow reveals an LTM enterprise value to free cash flow EV-FC multiple of 19.5 times.
While WKL's EV/EBITDA multiple of 12.43 times is broadly aligned with the industry average 8, the company's superior financial characteristics argue for a significant premium. The sustained 6% organic growth, 16% organic growth in the critical cloud software segment, and the elite 27.1% operating margin place WKL well above the average profile of its blended industry peer group. Two high-growth, specialized corporate services sectors often command EV/EBITDA multiples considerably higher than 20 times. The current valuation framework, particularly the EV/EBITDA multiple in the 12-13 times range, appears modest for an organization generating double-digit cloud growth and margins approaching 30%. The market may still be classifying WKL using outdated metrics relevant to traditional information publishers rather than correctly recognizing its transition into a high-quality SaaS and expert solution vendor. As the contribution of high-growth cloud revenue, currently 19% of total revenue, increases and the economic success of the integrated expert AI platforms becomes unmistakable, a multiple expansion towards the 18 times to 20 times range for specialized B2B software peers is likely. This re-rating potential offers a significant valuation tailwind in addition to underlying operational EPS growth. Analysis of PE ratios also suggests a slight undervaluation relative to the company's own intrinsic fundamentals. One assessment indicates that the stock trades at an 18.6 times PE, which is marginally discounted compared to its fundamentals-based fair ratio of 20.3 times. Analyst consensus and forward outlook. The investment community holds a constructive view of Wolters Kluwer, with the consensus rating among 12 covering analysts being buy. 16 analyst projections place the average 12-month price target between 140.92 and 147.39 euros. 16. These targets imply substantial potential upside, estimated by some analyses to exceed 50% from certain reference prices. Management guidance for 2025 anticipates continued good organic revenue growth and further adjusted operating profit margin improvement. The outlook calls for mid-single-digit growth in diluted adjusted EPS, even in the face of explicit financial headwinds from higher financing costs and increased tax rates. This projected growth underscores the strength of operational improvements and the powerful accretive effect of the accelerated $1.1 billion share buyback program. The substantial capital return program is effectively acting as a financial lever, successfully mitigating external economic pressures and reinforcing the company's ability to deliver reliable EPS growth critical for meeting analyst price targets. Conclusion. Wolters Kluwer represents a high-quality, resilient investment opportunity, characterized by an exceptional financial profile and a strategically advanced position in specialized professional software markets. The analysis confirms robust financial health across all major statements. The income statement demonstrates a structural shift toward high-margin recurring revenue, successfully driving the adjusted operating profit margin to 27.1%, supported by 16% organic growth in the critical cloud software segment. This profitable digital migration, amplified by the launch of proprietary expert AI solutions across all major segments, secures long-term margin stability and expansion. The cash flow statement highlights superior financial discipline, with adjusted free cash flow consistently exceeding adjusted net profit, 1,276 million FCF in 2024, a structural advantage confirming the high quality and cash-generative nature of the earnings base. This FCF engine requires minimal fixed capital investment and fully funds the aggressive capital return policy. The balance sheet is characterized by prudence and efficiency, with a conservative net debt to EBITDA ratio of 1.6 times and elite capital efficiency metrics, including an ROIC of 18.1%. This strength ensures continued capacity for selective strategic acquisitions while maintaining financial resilience. The dividend safety is absolute, backed by the progressive dividend policy and the massive FCF coverage. The concurrent acceleration of the share buyback program, up to $1.1 billion planned, underscores management's confidence in the intrinsic value of the business and commitment to maximizing shareholder yield.
The current valuation, with an EV/EBITDA multiple in the low 12 times range, appears fundamentally conservative and insufficiently recognizes WKL's structural quality, accelerating transition into high-growth SaaS, and defensible market position. We believe that WKL is misclassified by the market, creating a significant valuation gap that should close as the success of the expert AI-powered expert solutions becomes more widely appreciated. Wolters Kluwer is recommended as a core long-term holding for institutional portfolios seeking stable, predictable growth, superior cash flow generation, and reliable capital returns, with significant potential for PE and EV/WM multiple expansion driven by the successful deployment of next-generation cloud and AI technologies.